For viewers watching this video on Facebook and Instagram Reels, please visit bit.ly/algowealth to watch the complete video. We are now also on TikTok. The ID is AshwinPPC09. On Tuesday, 4th October, the Dow surged 825 points. The S&P rose 3.1% to 3790 after dropping below 3600 last week. And the Nasdaq went up 3.3%. Now the Dow has climbed 2,000 points in the last 48 hours after closing below 29,000 on the last trading day of September. The UK's 10-year yield yesterday dropped to 3.86%, down from its multi-year high of over 4.5%. That sent the US 10-year yield down to 3.61%, down from a multi-year high of over 4.3%. Investors take note. The US 2-year Treasury yield fell to 4.097% yesterday, below its multi-year high of over 4.3%. Now, what triggered the drop in bond yields? On Tuesday, data showed that job openings for August were 10.1 million, down over 1 million from the prior data. This means that companies are hiring less and preparing for waning demand. It also could put less upward pressure on wages. That, in turn, could reduce the incentive for companies to raise prices, thus causing inflation to drop. That would keep the Fed from raising rates by more than it currently expects, keeping a lid on Treasury rates. That's how the market interprets the move, this thing that happened yesterday, and that's why stocks went up. Now, the jobs opening data follows on the heels of some weaker than expected data as part of the weaker than expected ISM manufacturing report. So the hope is that the Fed won't bring the Fed funds rate above the 4.6% level implied by its most recent summary of economic projections. Now, before we jump, like we said, the main event is still the September inflation data, which will be released on October 13th. Why? The Fed has not changed its rhetoric and still wants inflation to drop to 2% before it stops raising interest rates. And the current plan is to raise the Fed funds rate to 4.6%. Citi Global Wealth warns that this is a bear market rally still, and that the market is not out of the woods yet. Okay, Citi warns not to fight the Fed, and so far as we have not seen a change in the Fed's trajectory. That's very important to know, and we should watch if inflation falls to 2%. Citi sees a 70% chance of a recession in 2023, and they say earnings will shrink by 10% next year. The S&P is now trading at 15 times forward earnings. And Citi does agree it is an attractive level and they are nibbling on quality companies. Please take note. In our special edition videos, we advise to buy 4 heirloom stocks. They are Microsoft, Amazon, Singapore's DBS Group Holdings, and Sembcorp Industries. Let us navigate you through this market volatility and seize a once-in-a-lifetime opportunity that have presented themselves as a result of the Fed rate hikes. Contact us at bit.ly/algotrader and subscribe to our YouTube channel at bit.ly/algowealth. And please visit our TikTok channel, AshwinPPC09.